Now that I've spent a little over a year trading the stock market, mostly options, I thought I'd go over the 9 most crucial lessons I've learned and I'm still working on so that you can increase your chances of being profitable with trading. Before I dive in, I should note that I do not claim to be an expert with trading. The stock market has been on a crazy bull run and even boring ETFs had pretty awesome returns last year, so just because I had a profitable year really doesn't mean much. But I believe these takeaways are just good trading practices to have in general, so I'd rather you learn them here than find out the hard way. The first part is tricky because when you're starting out, your strategy might just be like mine was, which was, I don't know, I just want to be profitable, I guess. And that makes sense because you don't know what you don't know, and if you're new to trading, how are you supposed to have a strategy? Well, I think it's best to break it down by first identifying what your personal risk tolerance is and then what your schedule allows. If you're working a full-time job every weekday during market hours, you aren't going to be able to day trade. Maybe you want to trade options but don't have time to watch the charts and exit at exactly the right time, so in that case you may find that waiting for a few stocks that you're bullish on to come down to your support levels before buying a long-dated call option is a good choice for you. Or maybe you don't like the riskiness of buying options and would rather just buy shares outright of companies that you like. And that's fine too, but unless you're planning on holding for 5 to 10 years, you probably want to establish some rules for yourself when it comes to entering and exiting trades. Personally, I'm still developing my strategy as I learn more and more what works best for me. Right now, my base strategy is swinging call options with a 0.3 to 0.5 delta of large cap stocks with 45 to 90 days to expiration. This means I buy call options, which is a bullish position. I swing them, which means I hold them at least overnight, maybe a few days to a month or two, and I buy them out of the money, which is a little riskier. The 0.3 to 0.5 delta means the options contracts will increase in value $30 to $50 for every $1 move that the stock makes. Once I'm in the trade, I look to start scaling out of my position at around 30% profit. I almost always buy more than one contract at a time, so I may sell 2 at 30% and then hold the others longer. If the stock is looking strong and making new highs, I may continue to hold until it looks like it's running out of steam. On the flip side, if a contract never hits 30% profit and instead turns against me, I try to start cutting my losses at around negative 30%. Sometimes though, if the entire sector or market is having a red day, I will hold past the negative 30% expecting it to rebound in the next few days. Since I usually have plenty of time on my contracts, I can give them a chance to move in the right direction before I decide to cut my losses. And this is why you should develop your own strategy. You may look at mine and think, so you're risking a lot of money for a 1-to-1 risk to reward ratio? That doesn't sound that great. But the truth of the matter is a lot of my winners go far past 30% because I get good entries by closely watching the charts every day, waiting for the right moment to enter. But 30% is generally the soonest I look to start taking profit, but if a stock is showing strength, I will continue to hold for higher returns. Okay, so you have a rough idea of your strategy. Now you have to stick with it. Discipline is the hardest aspect of trading and a reason why a lot of people fail. And if we look back at my strategy I just outlined, it's honestly not very disciplined either, so it's something I currently struggle with. Another issue I struggle with is I get too attached to a number in my balance, and on red days, I'll cut losses just to temporarily stop the bleeding because maybe I feel emotionally attached to being above $30,000 and it's getting close to dropping below it. Even though I've seen my positions end up green after holding through a few red days, sometimes just seeing my account balance start to drop below some arbitrary number is enough to make me make a poor decision. I actually just did this last week with Baidu where I had recently entered a position that was supposed to be a longer term play, but when the market had a few red days, it had a big impact on my daily profit and loss, so I eventually just cut it. And then I just watched it regain all its value and then some the next day. It hadn't even come that close to my 30% stop loss. Shouldn't have done it. Other ways you can fail here is by taking revenge trades after losing money, chasing hype stocks, and just otherwise not following your own rules. This is where going back at the end of the week or the month to analyze your losing trades can be really helpful. Where did you go wrong and what can you do to avoid it next time? Write your rules down on a sticky note and put it on your computer monitor if you have to. If you can remove emotions from trading, you'll be much better off. Another thing to consider is this: scale in and out of your positions. Instead of taking all of your money and just dumping it into your favorite stock all at once, try scaling into your position. This applies to both shares and long-dated options contracts. Let's say you want to buy 100 shares of Apple. If you've charted your support and resistance levels like I talked about in this video, and you feel confident in the company and the market, you don't need to buy all 100 shares at once. You can start with a smaller position and add to it over time. The benefit of doing this is it allows for imperfection. If you think you bought the dip, but the stock continues to drop, scaling in gives you the opportunity to buy up more at a lower price, lowering your cost basis or the average price of your position. If the price goes up, you can feel more confident in your play and add to it accordingly. You can see I did this with my GameStop trade. Of course, hindsight would tell you I should have just bought all the shares I wanted when the price was the lowest, but trading doesn't work that way. When the stock started going up, I became more confident in the play, and I felt good about liquidating other positions to add to my GameStop position. Likewise, when it's time to sell, you don't have to sell all at once. Many times my trades will hit 100% profit, allowing me to sell half of my position and keep the rest of the contracts running risk-free. Once again, this allows for imperfection because it's impossible to nail your exits and entries all the time. If the stock keeps rising, you'll still have a piece of the action, and once it levels off or starts selling off, you can close out of your position completely. So many times the best trade you can make is actually no trade at all. And while that may sound like boring boomer advice, it is true. If the market is moving choppy without a clear direction, do you really want to enter a trade at that time? Or if you just closed out of a losing trade, it can be tempting to try and earn back that money you lost by making another trade. But this can be a slippery slope and lead to even more losses. Sometimes the best thing you can do is just sit on your hands and watch. Watch the price action, look at different sectors, and just see how stocks are moving without being in any trade at all. I see a lot of new traders who feel like they always have to be in a trade, but so many times the better play is just to sit on the sidelines and wait. If you force trades, you'll break your rules and you will lose money. Instead of overtrading, spend time continuing your education. Read articles, blog posts, watch videos, practice charting support and resistance, etc.
Great advice. Hurts my feelings every time.
Another thing you may find yourself doing is loading up your charts with tons of indicators, and that's totally fine. But after you spend some time watching the markets with whatever indicators you load up, get rid of the ones that just add noise and confusion and don't actually help you with your trading. Here's an example of the way my thinkorswim looked when I was starting out. Then I got rid of all the crap and just drew my own support and resistance, and that was about it. Now I've added some exponential moving averages to my chart, but by default, that's all there is. If I am doing quick scalp trades, I do add a few more indicators like VWAP, but in general, I find a nice clean chart can help you see things more clearly. Don't overcomplicate things. There won't be one magic indicator that will turn trading into a money printer for you, and it will depend on your style of trading, but like I said, if it's just adding noise and not actually providing you with useful information, get rid of it. Trading can be as simple as you make it. This is a big one, and if you get bankroll management wrong, you can say goodbye to making a long-term profit with trading. I would never recommend risking more than 5% of your account per trade, and ideally more like 2 to 3%. But of course, I know when starting out with options trading on a small account, it's virtually impossible unless you implement spreads, which can be confusing for beginners. I get confused by spreads all the time, even when I understand them theoretically. So when I first started my main brokerage account, I only had $1,500, so I definitely risked closer to 60% of my account with a single trade, and I knew that going in I could definitely lose it all, and I would be okay with that. Definitely don't put your rent money in the stock market. If you are risking a larger percentage of your account on a single trade, give yourself a tighter stop loss so you can cut your losses before they come too great. And if you do have profitable trades, I would recommend making withdrawals. Like I showed in my video last week on my profitable trades, I withdrew $40,000 from my Robinhood account almost immediately after a big win because I wanted to preserve that capital and not do something stupid with it. Maybe you have a goal of growing a small account to get over the $25,000 mark so you can day trade. In that case, maybe set your threshold to take out anything over $40,000 at the end of the week. Just an example, but the idea is to secure some profit by getting it out of your regular trading account and into something like a checking or savings account. This next one is for options trading specifically, but maybe the most important lesson I learned is to buy time on your contracts. You may be tempted by the inexpensive contracts that expire in a few days or a week, but these contracts are extremely risky. Now sure, I will trade some 0-day contracts every once in a while for a quick scalp, but in general, having a few months on a contract can really go a long way in keeping your account green. Yes, they are more expensive, but it does give you more time to be right. Remember back to my 100K options challenge when I bought a GameStop call expiring on January 15th? If I would have bought the same contract but expiring a month or two later, I may have been more inclined to hold onto the contract and make well over $100,000 on that play. Also, keep in mind how theta, or time decay, negatively affects your options contracts. The closer you get to expiration, the faster it will lose its extrinsic value. So the bottom line, buy time. Maybe it's 3 months, maybe it's a year, but give the stock time to move in the right direction so you can close it out for a profit. There's a lot of noise on the internet with what stocks are hot, which ones are memeing next, and which SPAC you should be invested in before it's too late. And it can be overwhelming. If you're just starting out, I'd recommend putting together a watch list of maybe 10 to 20 of your favorite stocks that you want to trade. Cycle through the charts throughout the day, mark them up, set alerts, and watch the price action play out. I think it'll be easier for you to identify setups and get a really good idea on how these stocks move throughout the week so that you can find the best opportunities to trade them. Once you get more comfortable with trading, you can branch out and play whatever you feel like, but I would try to keep your initial watch list on the smaller side and focus in on those. Lastly, manage your positions. What does this mean exactly? Well, it means 1, don't let a green trade turn red. Once it hits your price target, start scaling out. 2, don't let your losers obliterate you. Close it out once it surpasses your stop loss level. And 3, don't open too many positions. I've fallen victim to this one many times, and sometimes I still do. But if you have 10 different open plays, you're gonna have a hard time focusing, staying disciplined, and staying profitable. And I'm not talking about your buy and hold stock portfolio. That's fine to keep diversified with different positions. But for trading, especially with options, try to keep it between 1 to 3 plays at a time when you're starting out. It can be tempting to jump into a play here and jump into a play there and take a shotgun approach hoping something hits, but trust me, it's better to limit your positions. Pick only the most favorable setups to enter, the trades you have the most conviction in. Let the other ones go. Okay, those were my 9 biggest takeaways from my first year of trading, and I really hope this helps you with your trading so that you can have success. If you've got some lessons you learned yourself, I'd love to hear about it in the comments below. I always enjoy hearing advice from more experienced traders because chances are some of them have learned things the hard way, so if I can avoid some of their mistakes and increase my profitability, I'm all for it. Do me a solid and hit the thumbs up button on this video, consider subscribing if you haven't already, and I will see you in the next one.